Okay, so what if the secret to successful investing isn't, about having these super complex algorithms or getting some kind of secret insider tip? What if it's actually way simpler than that? Almost. Well, almost random. Could figuring out the whole madness of crowds thing and maybe your own psychology be the real shortcut?
That's a huge question, right? And it's exactly what Burton G. Malkiel dives into in his classic book, A Random Walk Down Wall Street. It's really stood the test of time.
It really has. So, in this deep dive, we're going to unpack this essential investing book. Our mission really is to pull out the most important ideas, the nuggets of knowledge, and maybe some surprising insights from Malkiel's strategies.
Yeah, strategies that have held up. We want to give you clear explanations, stuff you can actually use, practical takeaways, and hopefully, a bit of inspiration to feel more confident about your own financial path.
Exactly. We'll get into some core ideas about how things are valued, look at some infamous speculative bubbles, those are always
Right.
fascinating, and see why they happen. We'll challenge some common ideas about predicting the market, and then crucially, boil it all down to steps you can actually take, like right now, to build and protect your wealth.
Sounds good. So where do we start? Malkiel lays out these two kind of competing ideas about how Wall Street works, right?
Right. Two big philosophies. The first one he calls the firm foundation theory. What's that about?
Okay, so this one, it's the idea championed by guys like Benjamin Graham and Warren Buffett,
Hmm.
the value investing legends. It
Mm-hmm.
basically says every stock has a real intrinsic value. This value comes from the company's future earnings, its dividends, its overall financial health. It's about digging into the fundamentals.
Like figuring out what a house is really worth based on the land, the building, potential rent, that kind of thing.
Exactly. You're assessing its solid foundation. Very logical, very analytical.
Okay, makes sense. But then there's this completely different way of thinking. The castle in the air theory. How does that one work? It sounds a bit more flighty.
It kind of is. This theory, which John Maynard Keynes talked about, is less about intrinsic value and, well, much more about guessing what the crowd is going to do.
Crowd psychology.
Yeah. The idea is you buy something not because it's fundamentally worth the price, but because you think someone else, a greater fool, as they sometimes say, will pay even more for it later.
Ah, the greater fool theory. I've heard that one.
Right. An investment's value is just what you think you can sell it for. Keynes apparently did quite well himself, spending like half an hour each morning trying to figure out what the general public would value differently, just a little bit ahead of him.
So it's all about riding that wave of opinion. Forget the solid ground underneath. And I guess it's this castle in the air thinking that fuels those wild market swings, the booms and busts Malkiel calls the madness of crowds.
Precisely. That's where the historical examples get really interesting. Malkiel shows how this irrational behavior, this focus on castles in the air, consistently creates the same pattern. A huge run-up in prices,
Mm.
driven almost purely by hype and speculation. And then, bam, a sudden, usually brutal collapse. It's like a cycle that just keeps repeating because, well, human nature doesn't seem to change that much when it comes to greed and fear.
Can you give us an example, something that really shows this madness in action?
Oh, definitely. One of the most classic and kind of unbelievable examples is the tulip bulb craze back in 17th century Holland.
Right, the tulips.
Yeah, certain tulip bulbs, especially these bazaars with unique stripes caused by a virus, actually became insanely expensive. People were trading houses, land, their life savings for one bulb.
For a flower bulb, that's nuts.
Totally nuts. They even traded what were essentially called options on bulbs as pure frenzy. And Malkiel uses this to show, look, when enough people get nervous and decide to sell, panic just takes over, and the whole thing collapses just as fast as it went up. It had nothing to do with the value of a tulip.
Wow. And you see echoes of that much more recently, too, right? It's not just ancient history.
Absolutely not. Fast forward to the internet bubble around the year 2000. Remember that?
Oh, vividly. The dot-com boom and bust.
Exactly. The NASDAQ index basically tripled in value between late 98 and March 2000. Just pure excitement about the internet.
Companies were just adding .com to their name, and their stock would shoot up even if they sold, I don't know, pet food or something.
Right. Like that famous example of Long Island Iced Tea Corp, briefly becoming Long Blockchain Corp,
Mhm.
later on Instant Stock Search. During the dot-com era, you had celebrity analysts pushing ridiculously overvalued stocks, and the accounting. Oh, boy.
Enron, WorldCom.
Yep, Enron's fake trading room. WorldCom basically pretending operating expenses were capital investments. It
Hmm.
was rampant. And because online trading was suddenly so easy, tons of individual investors, especially day traders, got caught up and lost everything, sometimes in just a few months, chasing those digital castles in the air.
It's uncanny how similar the human behavior is, whether it's tulips or tech stocks or, even crypto more recently.
That's Malkiel's point. The specific asset changes, but the psychology, the speculation, the eventual hangover, that stays remarkably consistent. These speculative binges always end, and usually very suddenly, like an earthquake. Very few people get out unscathed.
Okay, so if these bubbles show how dangerous chasing castles in the air is, and prediction is clearly so hard, why do so many people, even professionals, still try to outsmart the market?
Well, that leads right into Malkiel's central argument, which is basically why trying to consistently beat the market is usually a fool's errand. Comes back to the random walk theory.
The like a drunk person stumbling unpredictably.
That's the classic analogy, yeah. Malkiel explains it really well with a coin toss experiment. Imagine flipping a coin. Heads, the stock goes up half a point. Tails, it goes down half a point. If you chart those
It
results,
looks like a real stock chart sometimes, with trends and cycles.
exactly. It looks like there are patterns, but it's completely random. The core idea of the random walk is that past price movements tell you absolutely nothing reliable about future prices or how long a trend might last.
Because any new information gets baked into the price almost instantly?
In a reasonably efficient market, yes. Old news or apparent patterns are basically useless for making future profits consistently.
Okay, that must ruffle some feathers on Wall Street. How does this random walk idea stack up against the common ways people do try to predict the market, like a technical analysis?
Right, technical analysis. These are the chartists or technicians. They're the ones looking at charts of past prices and trading volume, searching for patterns. We hear things like head and shoulders or resistance levels.
Trying to read the tea leaves in the stock charts?
Pretty much. They believe market movements are mostly psychological and that charts reflect that psychology. But here's the kicker. Malkiel points to study after study showing that once you factor in trading costs and taxes, these technical methods just don't consistently beat a simple buy and hold strategy.
So the patterns they see might just be randomness, like in the coin toss example.
Very likely. Malkiel even tells stories about technicians who failed and blamed it on, get this, not believing their own charts enough. It shows how much we want to see patterns, even when they aren't predictive. Like thinking a basketball player has a hot hand. Studies show that's mostly a myth too. Random streaks happen.
Okay, so technical analysis gets a thumbs down. What about fundamental analysis? That seems much more sensible, right? Looking at the company's actual earnings, debt, management.
It definitely seems more logical, more grounded. But Malkiel argues even fundamental analysts face huge challenges. First off, there's the impact of just random, unpredictable stuff.
Like what?
Well, a company's amazing new drug fails its final trial, boom, stock crashes. Or a natural disaster hits, or regulators change the rules. Malkiel mentions Celsius Corporation, its stock dropped 90% when a liver cancer drug failed. No analyst could have reliably predicted that specific outcome.
Yeah, you can't forecast luck, good or bad. What else makes it tough for fundamental analysts?
Another big one is, let's call it creative accounting.
Ah, cooking the books? Or maybe just spicing them up.
Exactly. Companies have a lot of leeway, and some push the boundaries or cross them to make their earnings look better than they are. Malkiel gives examples like Enron and Quest swapping fiber optic capacity at inflated values, or companies like Motorola and Lucent lending huge sums to customers who probably couldn't pay it back just to book the sale.
So the numbers the analysts are using might not even be real.
They might be, let's say, optimistically presented. Malkiel jokes that for some companies, EBITDA started to mean earnings before I tricked the dumb auditor. It makes relying solely on reported numbers pretty risky.
Wow. Okay, so unpredictable events, dodgy accounting. What about the analysts themselves? Are they part of the problem too?
Oh, absolutely. Malkiel points out plain old analyst errors and biases. He tells a funny but scary story about an analyst called Louis, who misplaced a decimal point in his copper price calculation. It made his earnings forecast way too high.
Did he fix it?
Nope. He apparently said the recommendation sounds more convincing with the wrong number. Analysts can be sloppy, or they might not truly understand the industry, like that example of biotech analysts whose predictions for different artificial skin companies added up to way more than 100% of the potential market.
The basic math errors and not understanding the field.
And then there's herd mentality. Analysts often look at each other's forecasts or just rely heavily on what the company's management tells them, the guidance. They don't want to stick their necks out with a prediction that's way different from everyone else's.
As Keynes said, it is better for reputation to fail conventionally than to succeed unconventionally.
Exactly that. It's safer to be wrong with the crowd than potentially right, but alone.
So if even the professionals struggle with prediction because of randomness, bad data, and their own biases, does this actually show up in the results of, say, actively managed mutual funds?
It shows up massively. This is a huge point Malkiel makes. The consistent underperformance of active management. Study after study, like the well-known S&P SPA reports, showed the same thing year after year.
Which is?
A huge majority of actively managed funds where managers are actively picking stocks trying to beat the market, fail to outperform their benchmark index. We're talking like over 75% of them falling short over 5 years. It gets worse over longer periods.
How much worse?
Over 15 years, it's often over 90% of active funds that underperform their index.
90%. That is staggering. Why? Is it just that they're bad stock pickers?
It's not necessarily that they're all bad pickers. The main reasons are much simpler: fees and costs.
Bah.
Actively managed funds charge higher management fees, and they tend to trade more often, which racks up transaction costs. These costs are a constant drag on returns.
So even if they match the market before costs, they lag behind after costs.
Precisely. Before costs, all active managers in aggregate basically are the market average. But after you subtract their higher fees and trading costs, the average active manager has to underperform the low-cost index. It's just math.
And Malkiel backs this up with quotes from investing giants.
Oh yeah, Benjamin Graham, Peter Lynch, Warren Buffett, they all at various points acknowledged the difficulty of beating the market consistently and advocated for low-cost index funds for most investors. Buffett's even famously said his estate should be put almost entirely in a simple S&P 500 index fund.
Wow. Coming from Buffett, that's powerful. So, okay, if trying to outsmart the market, trying to pick the winning stocks or time the swings is mostly a losing game, what should regular people do? Malkiel must offer some practical advice, right? A better way.
Absolutely. That's the really valuable part of the book. He gives a very practical guide for how to invest successfully using the idea of the random walk.
Okay.
It boils down to some pretty clear, almost no-brainer steps.
Okay, let's get into those. What's the foundation of his practical advice?
It starts with understanding modern portfolio theory, MPT, or at least the core idea behind it, which is the power of diversification.
Diversification. Don't put all your eggs in one basket.
Exactly. But MPT gives it a more scientific basis. It shows how you can actually reduce the overall risk in your portfolio without necessarily giving up expected return by combining assets that don't move perfectly in sync.
You mentioned a memorable example for this, the umbrella maker and the resort owner.
Yeah, that's Malkiel's classic illustration. Imagine an island with just two businesses, a beach resort and an umbrella company. Sunny weather. Resort booms, umbrellas don't sell. Rainy weather. Resort's empty, but umbrella sales go through the roof.
Okay, so their fortunes move opposite to each other.
Right, they're negatively correlated.
Right.
If you invest all your money in just one, your returns are super volatile, totally dependent on the weather. But if you put half your money in the resort and half in the umbrella company,
You get a much steadier return overall, right? Because one is always doing well and the other is doing poorly.
exactly, your overall portfolio risk plummets. Now, finding perfect negative correlation in the real world is hard, but the principle holds. Diversifying across different industries, different types of companies, and especially globally, adding international stocks from developed and emerging markets significantly reduces your risk.
Because different economies don't always move together.
Right. Foreign stocks can offer higher potential returns sometimes, and they smooth out the ride. Even when correlations rise during crises, diversification still helps. And don't forget bonds. Bonds often act as great diversifiers against stocks, especially during market crashes like in 2008.
Okay, so diversification is key. Spread your money around smartly. But Malkiel also talks a lot about our own psychology, right?
Yeah.
Behavioral finance. Why is understanding ourselves so important here?
Oh, it's absolutely critical. Because, as Malkiel points out, often the biggest enemy to our investment success is, well, it's us. Our own built-in human biases trip us up constantly.
Like what kind of biases?
Well, a big one is overconfidence. We tend to think we're better investors than we actually are. This leads people, especially men, studies show, to trade too much, thinking they can time the market or pick winners.
And all that trading just racks up costs and usually leads to worse results.
Exactly. Then there's our tendency to see patterns in randomness, like we talked about with the hot hand fallacy. We think we see trends where none exist.
Okay, overconfidence, seeing fake patterns. What else?
Herd mentality. This is huge. We get influenced by what everyone else is doing. We feel pressure to buy when the market is soaring and everyone's excited buying high. And we panic and sell when the market tanks and everyone's pessimistic, selling low.
That famous quote comes to mind. There is nothing so disturbing to one's well-being and judgment as to see a friend get rich.
That nails it. That fear of missing out, or panic when others are panicking, leads to terrible timing. Studies suggest the average investor earns significantly less than the market return, precisely because they tend to buy and sell at the wrong times, driven by the herd.
Buying high, selling low. The classic mistake. Is there anything else?
Yes, loss aversion. Psychologically, the pain of losing money feels about 2.5 times stronger than the pleasure of an equivalent gain.
Wow, really? 2.5 times?
Yeah, roughly. So what does this do? It makes us hold on to losing stocks way too long, hoping they'll just get back to even, because selling locks in that painful loss. Or sometimes it makes us take wild gambles to try and recoup a loss, because the prospect of a sure loss feels so bad.
So our emotions are actively working against making rational investment decisions.
That's pretty much. Malkiel actually highlights a clever behavioral trick to counteract this, called the Save More Tomorrow plan. You commit now to saving a portion of your future salary increases.
Ah, so it doesn't feel like a cut in your current paycheck.
Exactly. It uses inertia to your advantage and bypasses that immediate feeling of loss aversion.
Smart, right.
Very clever. So the big takeaway here is know thyself, recognize these biases, overconfidence, herd behavior, loss aversion, so you can avoid making what Malkiel calls stupid investor tricks. Right. Like the poker saying goes, if you look around the table and can't spot the sucker, it's probably you. Don't be the sucker at the investing table because of your own psychology.
Okay, so we need to diversify and we need to conquer our inner demons. What are the concrete, practical, no-brainer steps Malkiel recommends we actually do with our money?
All right, number one, and this is probably the single most important piece of advice in the whole book, embrace index funds. Low-cost index funds should be the core, the bedrock of your investment portfolio.
Why index funds specifically?
Because they give you instant, broad diversification across the entire market segment. They track like the whole U.S. stock market or international stocks or bonds. They're incredibly tax efficient because they don't trade much. And crucially, their expenses are ultra low. And as we saw, low cost plus broad diversification means they consistently beat the vast majority of expensive, actively managed funds over the long run.
So simple, cheap, diversified, and effective. Makes sense. What else?
Start early and save consistently. This sounds basic, but the power of compound growth is just incredible. Malkiel talks about the rule of 72, a quick way to estimate how long it takes your money to double at a given rate of return. Even saving small amounts regularly, if started early, can grow into a really substantial nest egg over decades. Time is your biggest ally.
Okay, index funds. Save early and often. What about safety nets?
Crucial. Build cash reserves and emergency fund. You need cash set aside for unexpected expenses, job loss, whatever life throws at you. Murphy's Law, right? If something can go wrong, it will. And get proper insurance, especially cost-effective term life insurance if you have dependents. Protect the downside.
And taxes. We should try to minimize those legally, I assume.
Definitely. Leverage tax-advantaged accounts. Things like IRAs, traditional and Roth, and 529 plans for college savings. A traditional IRA gives you a tax deduction now. Your money grows tax-deferred. A Roth IRA uses after-tax money, but qualified withdrawals in retirement are tax-free. That's huge. 529s offer tax-free growth and withdrawals for education. Use these accounts.
Okay, index funds cover stocks and bonds. Should we consider anything else for diversification?
Malkiel suggests a modest allocation to things like gold, mainly for its diversification benefit. During crises, it often moves differently than stocks. Maybe also real estate investment trusts, REITs, which let you invest in commercial real estate and tend to pay decent dividends.
But keep it modest.
Yes, these should be smaller parts of the portfolio. And he strongly warns against chasing high-fee, complex things like hedge funds or private equity, especially for individual investors. The odds are stacked against you.
Got it. What about the strategy of investing a fixed amount regularly, dollar cost averaging?
Yeah, that's great discipline. Investing the same dollar amount on a regular schedule, say, every month means you automatically buy more shares when prices are low and fewer shares when prices are high.
So it lowers your average cost per share over time.
Exactly. It takes the emotion out of trying to time the market, which we know is nearly impossible. It's perfect for people saving consistently through, like, a 401k.
And what about rebalancing? Do we need to adjust things periodically?
Yes, that's important too.
Mm.
Let's say you decide on a target mix, maybe 60% stocks and 40% bonds. Over time, if stocks do really well, they might grow to be, say, 70% of your portfolio. Rebalancing means selling some of those winning stocks and buying more bonds to get back to your original 60/40 target.
Why do that? Isn't it good that stocks went up?
It is, but your portfolio is now riskier than you originally intended. Rebalancing brings your risk level back in line. And, counterintuitively, it forces you to do what's hard emotionally. Sell high and buy low. It can actually enhance returns sometimes while controlling risk.
Makes sense. Okay, what about adjusting the plan as we get older? Life cycle investing.
Right. Your investment mix shouldn't necessarily stay the same your whole life. When you're young, you have decades until retirement, so you can generally afford to take more risk, meaning a higher percentage in stocks for potentially higher growth.
And as you get closer to retirement.
You typically want to gradually shift towards more conservative investments, like bonds, to reduce volatility and protect your capital. Though, Malkiel points out, with people living longer now, even retirees probably need some stock exposure to keep up with inflation.
Are there easy ways to do this?
Yeah, target date funds are designed for this. You pick a fund based on your approximate retirement year, and it automatically becomes more conservative over time. It's a simple, hands-off option.
And when you actually are retired, how do you figure out how much you can safely take out each year? The withdrawal strategy.
Malkiel discusses the well-known 4% rule. It's a guideline suggesting that withdrawing about 4% of your portfolio's value in the first year of retirement and adjusting that amount for inflation each year after gives you a very high probability of your money lasting for 30 years or more, even with market ups and downs.
So a conservative starting point. And you should be smart about which accounts you draw from first, right?
Yeah.
Tax-wise.
Definitely. Generally, you'd tap taxable accounts first, then tax-deferred accounts like traditional IRAs, and leave Roth IRAs for last if possible, because Roth money comes out tax-free and doesn't have required minimum distributions during your lifetime.
Okay, one last crucial piece of advice from the book.
Yes, a really important one. Avoid concentrated risks. Specifically, don't tie up a large chunk of your investments in the stock of the company you work for.
Because if the company goes under,
You could lose your job and your savings at the same time. It's putting too many eggs in one very risky basket. Think about the Enron employees a devastating lesson. Diversify away from your employer's stock.
wow, okay. So putting it all together, the real path to financial success, according to Malkiel, isn't about chasing hot tips or trying to be the next market genius.
Not at all. It's really about informed simplicity. It's about discipline, sticking to your plan. And it's about trusting that over the long haul, a well-diversified portfolio of assets tends to grow. It's a marathon, like you said, not a sprint. Patience really is key.
It seems like in a world that's always selling complex, supposedly secret financial strategies, maybe the most powerful insight is just how elegantly simple building wealth can actually be.
I think that's exactly right. So the question for you listening is, what's the first practical step you're going to take after hearing all this?
Yeah, great question. We really hope you found this deep dive into a random walk down Wall Street useful. If you did get value from these insights, maybe hit that like button. It really helps others find the show.
And consider sharing it with someone you think could use a clear, straightforward guide to investing. And of course, subscribe to the deep dive if you haven't already for more expert takes on important books and topics.
Let us know in the comments below what other books or big ideas would you like us to dive into next time. We'd love to hear from you.